Unemployment isn't just about people without jobs. It's about an economy under pressure. In simple terms, unemployment happens when people who are willing and able to work can't find employment. But not all unemployment is the same. From frictional unemployment, where people are between jobs, to structural unemployment caused by changing industries and technology, and cyclical unemployment driven by economic downturns, each type tells a different story. The causes can range from automation and lack of skills to recessions and global crises. And the impact? It affects income, mental health, businesses, and even a country's overall growth. In this video, we'll break down unemployment, its types, causes, and real-world impact in the simplest way possible. Today, we will talk about unemployment explained, types, causes, and impact. So before we start, make sure to hit the like button and subscribe to my channel. Introduction. Understanding unemployment in a modern economy, unemployment is one of the most significant indicators of an economy's health, reflecting not only the availability of jobs, but also the efficiency, stability, and inclusiveness of a nation's economic system. At its core, unemployment refers to a situation where individuals who are willing, able, and actively seeking work are unable to find employment. It is important to distinguish unemployment from people who are not working by choice, such as retirees, full-time students not seeking jobs, or homemakers. Economists measure unemployment through the unemployment rate, which represents the percentage of the labor force that is jobless but actively looking for work. Institutions like the International Labor Organization, ILO, and the World Bank track and publish unemployment data globally, while national agencies such as the Bureau of Labor Statistics, BLS, in the United States monitor labor market conditions domestically. Unemployment is more than just a statistic. It directly affects income distribution, social stability, political decisions, and long-term economic growth. When unemployment rises, consumer spending often declines, businesses may struggle, and governments may face increased pressure to provide social support. Conversely, low unemployment can indicate strong economic performance, but may also create inflationary pressures if labor demand significantly exceeds supply. Therefore, understanding unemployment requires a comprehensive look at its definitions, measurement methods, underlying causes, different types, and broader consequences. Types of unemployment. Frictional, structural, cyclical, and beyond unemployment is not a single uniform condition. It exists in multiple forms, each with distinct causes and implications. Frictional unemployment occurs when individuals are temporarily between jobs or entering the workforce for the first time. For example, a recent graduate searching for their first job, or a professional who voluntarily leaves one position to find a better opportunity. Experiences frictional unemployment. This type is generally short-term and considered a natural part of a dynamic economy. Structural unemployment, on the other hand, arises from a mismatch between workers' skills and the skills demanded by employers. Technological advancements, automation, globalization, and shifts in consumer demand often create structural changes in industries. For instance, the rise of automation and artificial intelligence has reduced demand for certain manual labor roles while increasing demand for digital and technical expertise. Cyclical unemployment is directly linked to economic cycles. During recessions, such as the one triggered by the COVID-19 pandemic, businesses reduce production and lay off workers due to decreased demand, leading to widespread job losses. Seasonal unemployment occurs in industries that operate only during specific times of the year, such as agriculture or tourism. Additionally, disguised unemployment refers to situations where more workers are employed than necessary, resulting in low productivity, often observed in developing economies. Understanding these types helps policymakers design targeted strategies rather than applying uniform solutions to diverse problems. Measuring unemployment. Methods, challenges, and hidden realities. Accurately measuring unemployment is more complex than it may seem. Governments conduct labor force surveys to determine how many individuals are employed, unemployed, or not participating in the labor force. The unemployment rate is calculated by dividing the number of unemployed individuals by the total labor force, which includes both employed and actively job-seeking individuals. However, this measurement has limitations. It does not account for discouraged workers, those who have stopped searching for jobs because they believe no opportunities are available. Nor does it fully reflect underemployment, where individuals work part-time or in roles below their skill level due to a lack of suitable full-time opportunities. Some countries also track broader indicators, such as labor force participation rates and employment-to-population ratios, to provide a more comprehensive picture. Informal employment, prevalent in many developing nations, further complicates measurement because workers may not be officially registered or documented. The informal sector can mask the true extent of unemployment, as individuals may engage in temporary or low-paying work to survive. Therefore, while official statistics provide valuable insights, they may not capture the full scope of economic hardship or workforce inefficiencies. Causes of unemployment: economic, technological, and social factors. Unemployment arises from a combination of economic, technological, social, and political factors. Economic downturns remain one of the most significant causes, as reduced consumer demand leads businesses to cut costs and reduce their workforce. Technological advancements, while boosting productivity, can displace workers whose skills become obsolete. The shift from manufacturing to service-based economies in many countries illustrates how structural transformation can leave segments of the workforce vulnerable. Globalization also plays a major role. Companies may relocate operations to countries with lower labor costs, leading to job losses in higher-cost regions. Educational disparities contribute significantly to unemployment, as individuals lacking relevant skills may struggle to meet modern labor market demands. Government policies, including labor laws, taxation, and trade regulations, can influence employment levels positively or negatively. Additionally, demographic changes such as rapid population growth can create job shortages if economic expansion does not keep pace. Social factors, including discrimination based on gender, age, ethnicity, or disability, can also limit access to employment opportunities. Political instability and conflict further exacerbate unemployment by disrupting economic activity and discouraging investment. Thus, unemployment is rarely the result of a single cause. It typically emerges from interconnected forces shaping the labor market. Economic impact of unemployment: growth, inflation, and productivity. The economic consequences of unemployment extend far beyond individual job loss. High unemployment reduces overall economic output as fewer people are contributing to production and consumption. This decline in productivity can lower a country's gross domestic product, GDP, and slow long-term growth. Governments may experience decreased tax revenues due to reduced income and spending, while simultaneously facing increased expenditures on social welfare programs such as unemployment benefits and public assistance. Persistent unemployment can also lead to skill erosion, where workers lose proficiency over time, making re-employment more difficult. The relationship between unemployment and inflation is often analyzed through the Phillips curve, which suggests an inverse relationship between the two in the short term. For example, during periods of low unemployment, wages may rise due to labor shortages, potentially increasing inflation. Central banks such as the Federal Reserve monitor unemployment closely when making decisions about interest rates and monetary policy. Striking a balance between low unemployment and stable inflation is a primary objective of macroeconomic management. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.